Before the IRS ever sends a levy, there's a couple of things that have to happen. The taxpayer must owe the money to the IRS, and the IRS must have issued a notice and demand. It could be something simple, like I filed my return with a balance due, or maybe the client received a CP 2000, trust fund recovery penalty, audit penalties. Somehow or another, you must owe money to the IRS in order for them to take a levy action. And the taxpayer, after the demand was made, no balance was paid, and the taxpayer basically ignores the IRS, ignores that final notice of intent to levy, and does not ask for a hearing. How to prevent a levy? Dispute the amount due, pay the balance due, set up an installment agreement, submit an offer in compromise, get your client put into an uncollectible status. Maybe your client should be filing a bankruptcy. These are all things that will prevent a levy. And again, something a lot of people don't consider that we need to consider, and that is, let's take a look and make sure those assessments are valid. Whenever I get a balance due, I always take a look at that transcript. And I look at that tax due column, that TC 150. It says taxes are $100,000. I look at that return, make sure that return says $100,000. Believe it or not, sometimes the IRS might make a mistake. Maybe they added a zero or missed a zero, or added another digit, and maybe they don't owe $10,000. Maybe the original tax is only $5,000. Is the IRS missing some estimated payments that my client made? You've got to make sure that the assessments are valid. That's actually the best way for you to make good for your clients.